The roller coaster continues. This week we got all kinds of inflation data which moved the market up and down, mostly down. We're running into a patch here where the market is retracing some of the gains it's made in recent weeks. And it's pausing, and we hope it's only a pause and not something deeper than that. The CPI came out on Thursday. It came out at 3.2%, okay? And the stock market was very happy about that because it was less than what was expected. 3.3% was what was expected. But what people have failed to mention is that in the previous month, it was only 3%. So it went up, and somehow we're celebrating that it went up. The core inflation did come down a little bit. It came down to 4.7%. That's still very high. 4.8% was expected, and 4.8% was what it was the previous month. So it came down a little bit in core, but it went up on the main inflation number, I want to call it. So the stock market was just ecstatic, and it went up like 1% during the day. But then I think they reconsidered. It really was nothing. It was even a little negative in my mind. But the interest rates, I think, is what spiked it and dropped it down. It ended up the day going down 0.5%. And that's because of the interest rates. Now, the interest rates are inverted, which means that you get a higher interest rates for shorter time periods. But what's happening is that the interest rate on the long end is starting to go up. We thought that the interest rate would uninvert by the short-term interest rates going down, but that's not going to happen. In fact, that the only way the short-term interest rates are going down is if something breaks, and the Fed has it set up so that the banks have a lot of help, and they're going to have trouble failing. So you can forget about the banks failing in a mass way. There will be banks here and there that fail. There's always banks failing. This is nothing surprising. The CPI came out positive, and then the 30-year interest rate went up to 4.26%. Wow. The 10-year rate went up about to 4.16%. Wow. The 2-year rate went up to 4.82%. And what you can get in money markets, well, in 5 to 6 month to 9 month treasuries, you're getting like way over 5%. You're getting like 5.2 or 5.3% on your 6 month to 9 month treasuries. It varies from time to time, but it's well over 5%. So it was this increase in the interest rates, which strengthens the US dollar. And when the US dollar goes up, stocks go down, okay, in this strange world we live in. So the yield curve is going to uninvert by the long rates going up, which is going to make it impossible for people to buy houses. It's already impossible in places like California. Only 16% of the people in California can afford to buy a house now because the interest rates and mortgage rates have gotten so high. The American dream is on trial here. The Fed isn't going to lower short-term interest rates unless something breaks. I believe they're going to raise the rates and just hold it there, and it'll probably be held up through most of 2024. They've made it so the banks have difficulty failing. They have a discount window. They have a bank term funding program which more or less takes all the bad loans that the banks have taken on, and they give them what they were worth at face value, and so the banks don't take a hit. The Federal Reserve will say, "Oh, we'll take these and we'll just keep them till maturity, so don't worry about it." So they've bailed out the banks massively. They've spent hundreds of billions of dollars, like 300 or 400 billion, to bail the banks out. So that's not happening. So they've learned so much from the 2008 great financial crisis. In my last video, I warned that artificial intelligence stocks were ready to pop, that the air was going to come out of those somewhat. And Palantir was down 15% in 5 days. Now it's still up 140% year to date. So this is just some of the air being taken out of them. Is it going to continue is the question. A C3 AI, whose symbol is AI for artificial intelligence, was down 13% in 5 days, but it's still up 194% year to date. So we can see the air is coming out, but they're still holding up pretty well. A super microcomputer, SMCI, came down about 25%. But this is a stock that's tripled since the beginning of the year. So it's still up about 210%. Wow. But I don't think these are going to swing back up for a while anyway. And they probably have downside continuing for a while, simply because the AI boom or mania is being settled down and the mania is being decreased. NVIDIA, which is the engine of artificial intelligence, was down 15% in the last 5 days. It's still up 180% year to date. And an event you want to keep in mind is NVIDIA reports earnings on August 23rd. And if they project that they've taken in revenue less than 11 billion, we're going to see all the artificial intelligence stocks come down severely, I think. So we're going into a bad time of the year where the seasonal effect in September and October is usually negative. And we only hope that the holiday uplift re-emerges and lifts stocks up. China has the opposite problem of the United States. China right now has deflation. The only thing worse than inflation is prolonged deflation. It's okay to have it for a short while, but they're not having it for a short while. Their CPI year on year went down a negative 0.3%. Okay, they are having actual deflation, which is hard to believe. Their producer price index, which foreshadows even lower CPI, was down 4.4% year on year. So China is in a lot of trouble, and Biden made the remark that China is a ticking time bomb. And I think a lot of it is due to their economic circumstances. Jobs have come down slightly, but not meaningfully enough for it to have any effect on the Federal Reserve. That's what keeps us from going into recession, is that the jobs numbers keep holding up with a lot of wage increases. UPS drivers have negotiated a contract that they can be earning like $170,000 in 5 years. So I guess you could become a doctor or a lawyer or become a UPS driver, and it might be sort of similar results economically for you. In this time of uncertainty, I turned to Berkshire Hathaway, and they reported earnings last week, and they were excellent. And Berkshire Hathaway's PE is only 18. Their metrics didn't look that good before they reported their earnings, but they did so well. And it's Berkshire Hathaway isn't really like, it's more like buying an ETF or a fund because they have so many companies and stocks within it. They own BNSF Railway, for example. They own Geico Insurance. They own See's Candies. They own furniture stores. They own a host of stocks. Their biggest stock holding is Apple. So he's gotten over his aversion to technology. And VeriSign, it's involved in internet infrastructure. And VeriSign has made 35% in the last year. And he owns some other technology stocks like Snowflake, and I think there's other people involved helping him invest. And I'm sure he gives these stocks his blessing. But I think on the technology side, I see them buying more innovative companies and companies important to the internet. He owns all sorts of banks and insurance stocks. He owns American Express. Coca-Cola is an old favorite of his. He owns Moody's credit rating agency. I mean, there's true diversification in this stock. This is more like buying an ETF or a mutual fund, the way it's. But he outright owns some major companies too, like Geico. Year to date, Berkshire Hathaway is up 16%. In the last year, it's up 20%. And in the last 5 years, it's up 73%. So it's a steady performer. And what's most to like about this stock in the current circumstances we're in is that it's safe. I think it's very well diversified, and it could benefit from inflation. And the price of oil, it went down to the 60s, then it got to the 70s, and now it's in the 80s. It could go back up, but I see oil as hanging in there. He owns 25% of Occidental Petroleum. He also owns some Chevron stock, So I think he's stumbled onto, and it's not stumbled. He spends all his time reading these reports on these companies and knows them quite intimately. And he goes for the long term, and that's worked out very well for him. He's pretty much a stock picking genius. So it's good to have a stock picking genius on your side. And I'm considering putting about $500,000 into it. I probably will put $250,000 sometime in late September. And I like to pick arbitrary dates because I find it's impossible to force myself to buy otherwise. I'm picking a time of the year that traditionally goes down. And so I'm thinking like September 24th, whatever weekday is around there. I will invest the first $250,000, and the second $250,000 I will put in October 15th. Now, these are dates where the stock market should be down, and hopefully we get a holiday rally and we go forward from that point on. So right now, this is what I'm doing. It's not financial advice because you have to make your own decision according to what's in your belief system and what your financial system is. So everybody has to make their own choices and do their own research. But I think we're in a precarious situation where I'm putting an overriding value on safety. And Berkshire Hathaway looks like the safest thing I can find that has a reasonable return. I'm still going to keep considerable money in money markets as backup, and I will continue to look for safe investments as we go forward. I also want to announce I'm thinking of changing my format of this channel. I plan to do more weekly reports on the stock market. Basically, the stock market it's in a precarious situation. This is the most anticipated recession in history that I can remember. I can't remember waiting for a recession to begin. Peter Lynch has always said that waiting for a recession is probably a mistake, and I can see what he means. And so I want to pick something safe and just go with it. But I'm thinking I want to address topics of interest, such as artificial intelligence, such as the wars we're experiencing, more social issues that can affect the economics that we're going through. So I might become somewhat more political. I tend to be a moderate liberal, I guess I would say. I tend to be socially liberal and financially conservative. I think that's the perfect mix. I can't really find candidates very much that follow those beliefs. And I think if we had a strong candidate who was socially liberal and financially conservative, that we would be in for much better governance than what we've been receiving. Thanks for listening and watching. Be sure to hit the like button and share this video if you think it could be helpful to people you know, because these are uncertain times and safety is my main concern for right now. Thank you.